Hi, welcome to today's presentation. My name is Mike Tusaw, and I'm a financial advisor from St. Charles Wealth Management. Today's title is Plan the Trade, Trade the Plan. And this is going to be an exciting presentation. We're going to cover three things. We're going to cover why having a plan is so important. We're going to cover system evaluation and how you can evaluate a system for yourself when trading and or investing. And then finally, we're going to go over why risk management is so important. So let's ask ourselves the question, why is having a plan so darn important? Well, it's for a variety of reasons. When you put money into the market and take it out of cash, you're giving up control of that specific money. If your money is in cash, you can do whatever you want with it. You can deposit it, withdraw it. You have the world is your oyster, so to speak. As soon as you invest it into stocks, bonds, mutual funds, options, real estate, commodities, whatever, you don't have control of it anymore. It's controlled by the investment with which you are in. And once it's not under your control anymore, you have to make sure that you manage the risk in the best possible way. And so if you have a plan before you get into a trade or an investment, then you're making that decision when the bullets aren't flying, for lack of a better term. And so you're saying, I'm willing to risk this amount of money. So this is where I put my stop loss, or this is where I put my hedge in, whatever the case may be. Or perhaps it's a long-term investment saying, I'm just going to hold on to this for the next 10 years, no matter what happens. And that's how I'm going to do it. You can do that as well. It just depends on where you're going with it. When the money is being controlled by something else, i.e. the market, you don't have the ability to think as logically as you did before the money was actually in it. So because of that, you are prone to become a victim of both fear and greed, in that you might get out a little bit sooner than you should have because you were scared, or you might take profit a little bit later than you should have because you were a little bit greedy. Whereas if you have a plan before you get in, it typically tends to make life a lot better. So then the other question that's going to come up is, how do you evaluate if a system is actually good or not for your trading? Now, what we came up with here is just a basic way with which to evaluate a trading system. The concept of it is what I want you to keep. And it doesn't always have to be this amount of trades. In fact, it seldom, if ever, is. And it doesn't have to be these dollar amounts. It seldom, if ever, is. I just want to show you a way with which you can evaluate a system. Oftentimes, I'll hear people online say something to the effect of, I made 60% on this trade. I made 80%, with the thought that if you continue to do with what I do, you can make 60% every time. And that's never the case. Otherwise, those people would have solved the national debt by now. So have the understanding that, yes, you can make big money, but you can also lose big money. And how do you evaluate if it's right for you? So what I did here for this example is I came up with a way with which to evaluate based on 10 trades. Now, in doing this, let's say that we have $5,000 of trading capital. And when we do this, we're going to do this with 10 trades. Now, no matter what, you're going to have winners and losers every time you do something like this. So let's just assume 7 winners. And then, of course, you can't have winners without losers. Well, I guess I wish we could. Let's just say that you have 3 losers. Now, what you need to have an understanding of is how much money you're actually going to make when you win and when you lose. So let's say in this system, we make $500 every time we have a winning trade. Now, on the flip side, because it's maybe a more volatile system, we have to hang on a little bit longer. If it goes against us, we have to wait for it to come back. Who knows? In this case, we're losing $1,200 when we lose. But above, you can see we've won 7 times and we've lost only 3 times. We're up 70. We win 70% of the time. How can we lose? Well, we lose because of the fact that the amount of money with which we lose is $3,600, 1,200 times 3. And the amount of money that we win is $3,500, 7 times 500. Now, I'm not compounding the interest, and so this is just designed to be a very simple, basic example. But here's a way with which you can figure out if those wins for you are worth it, because oftentimes I've seen people make a little bit of money, but then when they lose, they give it all back rather easily. So this is a way with which you can do it. Now let's look at another example once again, we're going to go with $5,000 in trading capital. And we're going to do 10 trades one more time. And now this time, we're not going to win as many times. So let's say that we're only going to win 3 times out of 10. Now, of course, doing the simple math, that means we're going to lose 7 times. And as you're doing this, you could also set this up to where you have break-even trades as well. I just wanted to keep this simple for our example. Now, this time, though, you actually have $1,200 in winners when you actually win. And maybe you set your stop loss a little bit tighter. So that's why you're losing so much, because you have a tighter stop loss, let's say. You're losing $500 on losers. So by doing this, you can see that by only winning 30% of the time, you actually are a winning trader overall, even though you're only winning 30% of the time. It's about money management and setting up the proper system that matches what you are looking to do. Once again, neither system is right or wrong. Of course, well, the first one's wrong because you lose money on it. But my point is that make sure that you have a system that you're evaluating, not just one trade or 2 trades as you are doing this. Finally, I want to talk about money management and why it's so important. I want to do this by telling a personal story from December of 2018. Going into that month, I was very bullish on the stock market. And for our aggressive strategy, we were having a really nice year. We were having a winning year. And so I decided at that point in time that I wanted to protect what we had as winners, but also still have some potential upside. So in that instance, I bought an out of the money call for our system that we were using on the S&P. And so, of course, what happened is that the S&P took a nosedive and ended up not doing so hot in December. So that was an instance to where my market sentiment was dead wrong. But because of the fact that I practiced good money management skills, we were able to have a good year because I kept a lot of money on the sidelines and just bought a small out of the money call. I didn't use a lot of money to do it. And so by doing that, had the market gone did what I thought it was going to do, we'd have made some good money on the out of the money call, but it went the exact opposite way on me. And so because of that, we were protected. And so that's an example of why money management needs to be important, or needs to be more important than market sentiment 100% of the time. Because if I'd have been wrong on that, I'd have taken a great year and turned it into a losing year. But because of the fact that I put money management ahead of market sentiment, then that is why we were able to have a winning year that year. And if you did like the video today, I'd like to encourage you to subscribe to our channel. That's how we get our content out to more people. If you're looking for a financial advisor who practices what he preaches, so to speak, feel free to check out my website or follow me on Twitter at Mike Tusaw, stcharleswealth.com. Thank you for watching and have a wonderful day. Bye-bye.